So, all we need is for things to move back to normal in terms of exposure in
Right.
this space, this is just going to be a tsunami of demand. It's really quite tremendous.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. We have a fantastic discussion lined up today that I'm super excited about. We're going to do a deep dive into silver. And to do just that, we're fortunate to have with us Peter Krauth, founder of Silver Stock Investor and author of the book, The Great Silver Bull. Peter is a former portfolio advisor and a 20-year veteran of the resource market with special expertise in precious metals, mining, and energy stocks. This is going to be a fantastic discussion. Peter, thank you so much for joining us today.
Gary, it's my pleasure. I'm looking forward to our talk.
Wonderful. So we have a lot of ground to cover, so let's jump right in. Peter, a few nights ago, Iran sent some drone strikes and missiles into Israel. War hotspots seem to be popping up around the globe. The war could fizzle out or expand. That remains to be seen. But however, Israel has come out and stated that they plan to exact a price for Iran's attack. Geopolitical conflict has been on the rise the last few years. Based on your decades of experience, what impact will any of this escalating geopolitical tension have on metals prices?
So that is a great question, Gary. I appreciate it, and I do have some thoughts about that. From what I've seen, they certainly do impact precious metals. However, the short answer of it is if you don't have escalation, if you don't have this ongoing issue, if it doesn't get more aggressive, if it doesn't get wider and spread to sort of other areas, neighboring areas, etc., then typically the impact is relatively short-lived. I mean, we could be talking days, maybe weeks, but typically that is absolutely what I've seen. So that's kind of what I would expect if Israel strikes back. That's another trigger. If that ends up being the end of it, then I would expect that portion of the effect on the price of precious metals to dial back. But that doesn't mean we have a big sell-off. And as I say, that certainly has been my experience. I would see a limited impact time and price-wise.
I appreciate that. So mining magnate and billionaire Ross Beaty wrote in your book, I expect investment returns in precious metals will outperform all other investment classes for the foreseeable future. Can you speak into that statement by Ross?
Sure. I mean, it's hard for me to say more or better than Ross could because of his pedigree and his incredible sort of legendary status almost in the precious metals mining industry. But I fully agree, and that's what the book is about the opportunity that lies ahead of us in precious metals, and in particular, in my view, silver. Gold is at all-time highs. Silver is barely at half of its nominal all-time highs. So, just by virtue of the fact that gold is at all-time highs tells you many things. It tells you that inflation is an issue. It tells you that financial concerns, financial stability is an issue. I think one of the biggest reasons that we've seen in the last couple of years, let's say, the ongoing sort of relentless rise in the price of gold has been talking about geopolitics. And here's a great example. So Russia having walked into Ukraine was a trigger. There was a spike in the gold price. It dialed back after that. But the reaction, in my view, of the US, which decided that it was going to weaponize the dollar by freezing Russian assets, made a number of very wise, very large investors, sovereign investors, high net worth investors around the world look at that and say, geez, do I want to get caught flat-footed the same way? And they looked at the ultimate answer for preservation of value and liquidity and buying power. And gold is the answer. Silver is kind of a derivative of that, but gold is certainly the king in that space, is the answer. And so the amount of sort of relentless buying that we've seen in gold over the last couple of years really is just remarkable. A couple of interesting stats. I think it was 1,082 ounces, 1,082 tons of gold were bought in 2022. That was an all-time record. Last year's high was almost the same amount, was I think something like 1,037 tons. The annual supply of gold is about 4,700 tons. So if you do the simple math, that means about 1 out of every 4 ounces in the last 2 years was bought by a central bank. Wow. So, I mean, people need to think about what that means, what's going on, why are they being such aggressive buyers of gold? And it also, to digress a little bit, it also explains why perhaps the miners have not reacted. In other words, these are people who don't care really much about the price. They're buying it no matter what. They can print money to buy it if they need it, and I'm sure they're doing that. And they're not interested in the miners. And the miners have had some issues with rising inflation, has sort of eaten into their profits and pushed their costs up as well. So this is why if we, the normal reaction is that miners follow, and they have not, well, until the last couple of months, they had not followed. Now we've seen them really start to follow with these new all-time highs kick in gold. And so that's changing the dynamic. But what has happened, as I say, in gold in the last couple of years is really remarkable. And I think we are starting to see sophisticated investors and even now more retail investors pay attention and really understand what's happening. And they feel that they need to gain that same sort of protection from this sector. And I think, to go way back to your original question, I think that's part, at least, of what Ross Beaty is talking about, is that, when he wrote that, this was early 2022, right before the book came out. And we hadn't had these 2 years of massive buying in gold by central banks. The war in Ukraine had just started, in fact. So to predict some of this would have not been obvious, but because we had already been 2 years at that point after COVID had started, and there had been relentless money printing. In the last, until that point, when I wrote the book, I had a stat that showed that over the prior 20 years, the world's money supply was up 5 times. So, I mean,
amazing.
Exactly. So it was, if you think about what the effects of that are likely to be, it's not hard to expect, if you understand this sector, that it will tremendously benefit for probably at least the next decade.
Well, that's an amazing stat, the last part there, and it's wonderful to have a endorsement of the sector and where the future of the sector is going by somebody who has repeatedly proven to be prescient, successful, and every other glowing adjective you could put out there. So Peter, currently more than 75% of financial advisors have under 1% gold exposure for their clients and even less for silver. What does your analysis point to, being that the current metals allocations are so low? Meaning, do you see a big rush to the door here at some point?
I do. And I think that we're starting to see that these are the very, very early days of it. Costco selling 100 to 200 million dollars worth of gold every month tells you that the retail investor is absolutely starting to clue in on this. I think that percentage is going to change. I think that I don't know offhand what sort of the long-term normal is, or let's say a prior multi-decade normal is. It's probably at least 2 to 3 times that amount. At 1%, it's probably more like 2 to 3%. So, all we need is for things to move back to normal in terms of exposure in this space, and this is just going to be a tsunami of demand. It's really quite tremendous. So you don't need any kind of massive, sort of paradigm shift or whatever. People just need to go back to what has been the norm in history, and things will do very well just on that basis. So It's coming. All I can say again is that the last couple of months really show that this is the start of this coming back into norm again, this shift. And an interesting anecdote, I was speaking to an executive at one of the larger primary silver mining companies, and there aren't that many, but they've seen the volume of their shares triple in the last, say, few weeks. So they're calling up the traders on these at the trading desks and at these investment banks, and they're asking them, okay, well, what can you tell us? What's driving this buying? Who's doing the buying, and so on? And they're telling them that they're getting tickets for $10 million of purchase of a single stock, at once. They can't fill it all in one shot, but they have their way of dealing with it to get the order ultimately filled. But again, these are sort of triple normal volumes. It's easy to people can just go and look at a bunch of the larger silver producers you're going to see. These are, and they're being told by the traders, these are generalist investors, funds, high net worth individuals that are starting to come into this space, have started to shift. They've seen tech has been a tremendous run, probably for, say the last 3-4 years. They're recognizing that it's more than fully valued, and they're looking to rotate, basically. And they're having an easy time choosing the right sector to rotate into, because it has been so incredibly undervalued. It remains very much still undervalued, but they see that, they're recognizing it, and they're taking some of their funds out of these other sectors and moving it into where there's some deep value. And that's starting. And obviously, all-time highs in gold is not hurting. So that's going to help the bottom lines of these miners as well.
Yeah, and I would like to just piggyback on what you just said and just add the fact that usually when there's a reversion to the mean, it overshoots the mean. And so here we are under 0.5%. The mean is 2 to 3%. And like you were saying, for a sector this small, you don't need a explosion of demand up to 7, 8, 9% in order to blow out some of these stocks. So just getting it back to mean would be amazing. But normally there's, in a reversion to the mean moment, it shoots past.
Absolutely. That's part of, say, sort of the potentially the blow off or mania phase that comes later in the cycle. There's some interesting research by Oxford Economics that goes back about a year and a half, and they looked at the silver sector specifically and people's exposure to silver. They looked at, they did portfolio analysis, and they said, and we're just talking silver, we're not even talking silver stocks. So silver itself, they looked at the last 20 years, and they said, okay, let's say in a medium risk portfolio, how much exposure to silver is ideal? So what brings you the best returns? So it's maximizing returns, and it's minimizing risk. And the ideal allocation to silver itself was 5%. And then they looked at going forward. They said, okay, with certain assumptions based on where gold is right now, silver's relative, undervaluation versus gold, and where we see inflation going, et cetera. And they said, we're going to come up with a forecast for the next 10 years, for example. And again, for a medium risk portfolio, their suggestion was that the ideal allocation would be a little bit more, would be 6%. And so digging deeper, the average portfolio has 0.2% exposure to silver, and its indirect exposure through commodities producers. For example, you could have like a large base metals company that produces some silver, a large gold company that produces some silver. And so it's really quite far off that exposure. So they would, if you were to try and do what Oxford's recommending, the average person would have to have something like 30 times the exposure they currently have to silver to reach the 6%, the ideal portfolio allocation. So, I mean, the upside is just, again, it's tremendous.
Yeah, it's massive. All right. So since gold's breakout like 6 weeks ago or so, there have been multiple gold and silver rebounds happening that were not happening in the past. In other words, when news that was negative to the metals came out, the metals would sink and they would stay down. But that was before this breakout. something is different now, as those types of situations that are causing the metals to fall, they just can't seem to keep those metals down on the mat very long. Several analysts are saying that they've never seen this before in the gold and silver markets, that they're having incredible resilience. What's your take on this resilience by the metals, and what does it mean for future price action?
So, there's a couple of things. I think one of them is the fact that we've got the Fed, time will tell, but we've got the Fed and other central banks pretty much committing to rate cuts. So I think that's been a bit of a shift, so that they've committed that we're going to see these rate cuts, whatever number, starting at some point later this year. So the market is, precious metals are happy about that. And yet at the same time, they're kind of stuck between a rock and a hard place, because at the same time, inflation has stayed high. U.S. inflation, last numbers were recently out. I think it was something like 3.5%. If you looked at the last, I believe it was at least 6 months, it has not been below 3%. Yet the Fed's target is 2%. So, and I've been saying for about a year and a half, ultimately the Fed and others will have no choice. They're going to have to cave, and they're going to have to kind of rationalize things. They're going to have to revise their 2% target. And I think they're going to come out with a 3% target. I think, as I say, the combination of really sticky price inflation, of some commitment to cutting rates despite that, is what has the market looking at this and saying, okay, this is time. I mean, prices are not coming down, and yet we're going to return to an environment where we have possibly negative real rates, and that's very positive for precious metals.
Yeah. So, when you talk about the debt and inflation situation, the debt load is just off the charts, and they're projecting 1.6 trillion in the cost of what it would to manage the debt year in and year out, 1.6 trillion by the end of just next year.
That's
so
right.
and $37 trillion, 1 trillion every 100 days or less, they're adding to the bottom line. So with the debt load that's off the charts, it feels like that's going to apply pressure to the Fed, because that 1 trillion up to 1.6 trillion and growing is crowding out other necessary expenditures from the budget. So it feels like the Fed's going to be pressured by that growing number to drop rates. However, like you mentioned, inflation is elevated and sticky. So they're in this spot, right? But if they do end up dropping rates, what is going to be the impact on gold and silver? I mean, isn't that very inflationary?
Yeah, absolutely. Because if you're dropping rates in an environment where inflation is high and staying high and above target, that to me tells the market that you've been playing a game of chicken with them, and they blinked.
Right.
They've admitted at that point, we can't do this anymore. We prefer to let inflation run high. And unfortunately, and I talk about this in the book, it's a situation where you have what we call financial repression. So you're keeping rates purposely below market, so that you inflate away your debt, and it makes it easier for this large debtor to pay back. And it's bad for savers. There's no question about it, because you're going to have a CD that's paying you, if you're lucky, maybe 4%, and real inflation is going to be somewhere around 5 or 6 at least. So you're at least negative a couple of percent, maybe more every year, and you lose buying power, and people certainly will not be able to live off of the interest that those savings are paying. They're going to have to start spending down the capital, and it's not good for the average guy, but it's really versus raising taxes, for example, unpopular. So allowing inflation to run high is absolutely, in my view, the way that the approach that's going to be taken.
Yeah, and so not good for savers. I want to underscore that. However, I would like to augment that by saying, unless you own gold as your savings vehicle.
Great point.
Gold and silver.
Depends how you save.
Right. Okay.
If it's in fake or real money, it all depends.
Right. So you have a report that calls silver the new oil and the next uranium. Will you speak into that, please?
Absolutely. So, silver is indispensable in its single largest application, which I call now the 800-pound gorilla in the silver space, and that's solar panels, photovoltaic. Last year, or recently, in fact, the Silver Institute put out numbers showing that industrial demand. So until a couple of years ago, industrial or silver, the silver market demand was really about half monetary. I call monetary. If you combine silverware, jewelry, and investment, it was about half. The other half was industrial. Industrial includes things like um, uh, solar panels, electronics and electrical. It includes things like medicine. It includes things like chemical or industrial applications. So that's the other
Military?
half. Absolutely. And that's an interesting one because we have no numbers really on military, and that's probably on purpose for us to know what level of consumption military requires of silver. But I've heard numbers like tens or dozens of pounds in a single missile, for example, of silver. So that's a lot of silver that you don't recuperate after once that thing is fired off. So um, there's been a shift, I think, in a large part because of electronics, EVs, and solar. There's been a big shift, and industrial demand has now become closer to 60% of the silver market. And within that 60%, you have 30% of the industrial demand going to solar alone. So you do the math, you're at 18, 19, 20% of the entire silver market is going to one single application, and that is solar. Solar's been growing by leaps and bounds over the last few years. The International Energy Agency forecast that by 2027, so just 3 years out, solar will be the single largest source of new electricity. You have India that just had an interesting headline a couple of days ago. They're building the world's largest renewable energy park. It's solar. It's going to be larger than Paris. That's
Wow.
going. India had in February had, I think it was 74 million ounces of imported silver. It was something like 63% of all of 2023's imports in
Yeah, I actually had a
February
question on
alone.
that. So that's what it was, almost all going to solar.
I believe so. Exactly.
And
Exactly.
are you expecting other countries to follow suit?
Well, solar's become, and that's one of the reasons the International Energy Agency sees it as the largest new source of energy in 3 years, is because the costs have come down so much. So, lots of countries are looking, one, they have all these mandates to fill, energy transition and green sources of energy, low or no emissions. And so they're turning to solar. In many places, it's highly subsidized, so that makes it quite cheap. And so people are turning to solar, and we're seeing it everywhere, pretty much almost everywhere around the world. And so, yeah, I mean, that's just going to require more silver. So it's possible. The latest stuff that I've seen, the latest research I've seen says that, it depends who you read, but that there may be not a stop in growth, but a little bit of a slow in growth. So not quite the same pace of growth in solar panel production. Um, so still more silver required, but that, as far as I'm concerned, is going to be tempered. That sort of slowing of growth is going to be tempered by the amount of silver that goes into each panel, because
Mhm.
the standard panel is a technology called PERC. And then you've got the next one called TOPCon. And already Silver Institute thinks that new capacity, solar panel capacity this year, 50% of new capacity will be this new technology, TOPCon. And the follow-on technology from that is called HJT. And so TOPCon requires 50% more silver per panel. HJT requires 150% more silver per panel. So even if
Goodness.
you had no growth, just flat, ongoing flat production, the fact still that we're shifting to these new technologies
Mm-hmm.
means we're still going to require more silver for solar. So there was some really interesting research. I think it's Baker Steel, a fund manager, that showed that they forecast within 3 years there's going to be a 20% deficit versus supply in the silver market, and something like, I think it was something like 300 million ounces. So that would be 30% deficit by 2030 in the silver market. So, we're going to have to find more silver, or the price is going to have to go up, or both. That's
Yeah,
how I
and
see
you would think with the green initiative and the length of time it takes to put in a new mine and have it get to production being 15 to 20 years, you would think, and with all the mandates, the government mandates that things have to be converted over by a certain date, you would think that they would have pushed for massive investment, 10 years ago to coincide, or 15 years ago to coincide with what is coming. Yet it feels like they did the exact opposite, and they're strangling the investment in new mining, which means at the very moment that we're going to need this historical amount, we're actually going to have a smaller amount of high functioning mines to pull from.
Exactly right. And there was I didn't go into the detail of it, but I saw a recent headline. It was Morgan Stanley saying that we're, in the US specifically, there's going to be a massive boom in activity by US miners, because there's no other way to try to get supply other than producing more. And if you're looking for friendly, so to speak, suppliers, then you're going to look at home first. And so they believe we're going to see a massive commodities boom. US specifically is going to see a massive commodities boom over the next decade, for all these reasons, because the supply will have to come, a lot of it will have to come from home, and or friendly allies.
So
it's going to be inevitable.
Yeah, what it reminds me of. So the shale boom. Had you invested in the shale boom, when it was in its infancy, over there in South Dakota area, etc., before it really started taking off, and when they were saying no, these shale areas are not going to produce, be major producers. In fact, it seemed like during the administration back then, they were even trying to slow it down, prevent it from coming online, or at least that's the way it felt. But then obviously not only did it explode, but it became the dominant growth force in oil in the world. That's over right. Over the last decade. And had you been an investor prior to that, when they were saying, nah, this isn't going to be much, but yet, that was forced, that was needed, that would have been life-changing.
Exactly. And yeah, I completely agree. And I think that you're right. Governments are reactionary. They're not forward thinking. And so that explains, as you say, they've kind of more than anything gotten in the way. And so I think what's going to force, dealing with this in a more supportive way is going to be price. So, until prices for these commodities, if we think we've seen inflation so far, hang on to your hat, because, you have all these mandates. You want to transition to clean and renewable energy. You're going to need these metals. You're going to need all these inputs. And you want to get them from friendly sources. And yet there has been almost no investment in that. So what's going to make, sort of really be the impetus? And I think we're going to see really, really strong rises in the prices of these commodities. And that is going to force the government's hand. And they don't have to cut corners. I'm not saying cut corners, environmentally or anything like that, but streamline things, help the companies get through the steps they need to get through to bring these mines to production, on a faster timeline. Cut it from 15 years to hopefully maybe 3 years, or 5 years even. That would be fantastic. And it's still slow, But, if you're talking about from discovery to production, that would be tremendous. So they just have to really help be much more facilitators than regulators.
It's certainly going to be interesting to see how things go. Are they going to be able to curtail demand enough to keep an equilibrium here? Or are they going to have to maybe bring down the economy for a period of time in order for that to take place? It's going to be interesting to see, because if it's pretty clear to see based on all the factors that this could quickly get away from them in terms of price. But speaking of price, so some analysts and experts are saying that silver might just be the most undervalued asset on the entire planet. Silver's recently broken a primary multi-year downtrend. There have only been 4 other such signals in the previous 20 years. The average result is about 100% gain and about 8 months. So when silver breaks out and it moves fast and it's highly explosive. So that, if this would be the 5th signal, that would put silver at about $50 an ounce by the end of this year. So is that what you're expecting?
I would be nice. I'm not sure. I mean, I'm not going to argue with those stats. Obviously, all things considered, it would have to repeat. Let's say you'd have to have a similar outcome again this time. No, I'm not saying that it's impossible, and given the kind of start to this year that we've seen so far, I'm not going to say it's impossible. I am going to be a little bit more conservative, and I do think that, I mean, I had called for $28 in Q2 this year. It took a few days to get into Q2, first few days of April, and we were at $28.
Yeah.
And I think that I had been saying 30 for sometime in the second half. I think realistically, we're going to reach 30. It's obviously not that far off. That doesn't mean, you don't start towards it from perhaps a little bit lower level than where we are now. But I think 30 is very realistic for the second half. And I think that $35 has now become much more realistic as well. $50 is absolutely in the cards, whether it's this year or not. I don't know.
Yeah.
But it's absolute. And I think that it's going to, being that I wouldn't expect to get there and just sail through it. That could happen. But I wouldn't necessarily count on that, just because it's been a ceiling for 50 years or more, right? 1980 and then 2011 again. So I would expect that it would act as overhead resistance, but once we get up above it in a meaningful way, I believe it's going to act as a new floor, new support, and then we will not revisit much below that for some time, or probably forever. Honestly,
that's amazing.
Yeah, I really think so.
So Peter, I'm going to read you a market psychology perspective that has been shared with me to get your perspective on it. Okay, so here goes. As gold continues to march higher, there is likely going to be a threshold that will capture the attention and the imagination of the retail investor. Maybe it's 2,500, maybe it's 3,000, who knows? But at some point, when their attention is captured, they will likely see the price tag on gold as being too high and feel like they missed their shot. And then they will realize, oh, wait, little sister silver over here is looking cheap. At that point, they'll likely pile into silver, trying to capture the same run-up that gold has had to that point, and that is when silver will really take off. So was this market psychology seen in the previous metals bull runs, and do you expect that to happen again?
So yes, it has been seen, and I agree with everything that you said. In fact, in my book, I talk about that. It's what I think most of us have heard more commonly called FOMO, fear of missing out. And I've used that example myself multiple times. I truly believe that, gold gets all of the attention. It gets all of the attention early on. It's the king of precious metals. Let's not deny it. It's obvious. So it gets all of the attention. And as you say, it's hard to know what that threshold is, but it's likely to be some kind of a big round number, 2,500, 3,000. People will pile in. Absolutely. George Soros has said there's no market like a gold bull market, right? People, it's like it just becomes insane almost at some point. People feel like they have to have it no matter what, no matter the price. And then, but that will be 2,500 or 3,000 will be quite rich for an ounce of gold for many people, and they will say, "Geez, what else can I do? What else is there?" And I absolutely believe, and that's why I think that to some extent there is this typical lag in silver, and I think that the investment part of silver is the wild card because industrial demand is a lot more stable and a lot more predictable. So I like to say that the industrial demand for silver provides this sort of rising floor under the silver price, and it's investment demand that becomes the wild card that provides these spikes from this rising level that drives it to these much higher highs. Yeah, absolutely. That's what I'm expecting to see play out. And so, we're still at almost half of nominal all-time highs. Anybody who has no exposure absolutely has time to get in. There are multiple ways to do it, and you don't have to take outsized risks to have exposure to silver.
Yeah, I appreciate that last comment there. So you touched on India earlier and their huge purchases recently, and thank you for educating us on that. It was for a solar farm the size of Paris. There have been reports that China is instructing their 1.4 billion citizens to now buy silver, and that the evidence is starting to show that they're starting to buy.
Wow.
What do you know about this? And if so, how powerful of a market force will this be?
So I had not heard that. So that's absolutely very interesting. As soon as we're done with this interview, I'm going to go Google that.
Okay.
And but I can't say I'm surprised. They did something similar a couple of years back, if I remember right, with gold and told their citizens to buy gold. I'm actually a little bit surprised in the sense that it's such a small market and supply is so tight. But I would not discount the likeliness or the impact of something like that would have. We're talking over 1 billion people, centuries of cultural affinity to silver and gold. People there are much better educated and much more comfortable with owning silver and understanding the reasons why. Just ask the Indians. They know all about it and the reasons why. And so I believe that being the case, that could have a huge impact. And I mean, there are a couple of examples that are so I'll say this, it doesn't, what the only part maybe that surprises me a little bit is the government support and sort of recommending. But for people to turn to silver on their own does not surprise me. In a recent presentation talked about how Turkey is experiencing something like 65 or 67% inflation, annual inflation.
That's just wild.
Their silver prices are up 7 times in the last 3 years. In Egypt has culturally an affinity to gold. They buy it as a gift for the brides, for newlyweds. They buy it as a gift for newborns. And they're turning to silver because they're saying silver is the new gold. Gold is too expensive. And they're buying silver much more readily now for gifts, for these kinds of gifts. And so the price of silver is up something like 2 or 3 times in Egypt in the last 3 years. So these are places that are very comfortable with precious metals and silver, and they absolutely are turning towards it and soaking up. One sort of last little bit on that, and it's from more of the industrial side, but I at a conference about a month and a half ago was speaking to a mining CEO, one of the few primary silver miners in the world, and they sell about half their production to China and the other half to the West. Well, he's telling me that the Chinese buyers are coming to them and saying, we really want our silver. We are prepared to pay for it 2 weeks in advance. We will actually pay up to $3 above spot per ounce to get our silver.
Wow.
So that's how tight the market is. They see it with the traders. They absolutely they know it's a very, very, very tight market. So, the silver has to come from somewhere, and
Right.
mine supply along with recycling, which are the two sort of regular supply sources every year, are not keeping up. They're essentially flat, and you have demand that's growing at a much faster pace.
Yeah, and when you consider the tightness of the current market and the rising demand and the growing industrial side, and then you layer in a China and an India and their scope and how big they are to start grabbing additional supply, all of this before in our Western funds and Western retail investors are getting in, that creates a mind-boggling equation for the supply and demand of silver when you really start to ponder that.
Absolutely, absolutely. And there's a good chance that it doesn't come in an orderly fashion, that it comes, in a big sort of tsunami kind of wave that people trip over each other to try to get some of it. And we don't even have to look far back. If you look back when COVID hit and the
Mhm.
panic set in, you couldn't get physical gold or silver. Try as hard as you wanted. The few dealers that were able to sell it to you were, I know, I remember reading reports, and I talked about this before, but in India, they were paying up to 100% premiums over the spot silver price just to
Wow.
get a few ounces. That's how badly they wanted. 75% above spot was typical. And then when it settled down, it was still at like 30 to 40%. And when you look historically, it's really normal is more like 12 to 15%. So it stayed at sustained high premium levels for years. So again, speaking to the tightness in supply, it's really quite impressive.
It is, and so China's getting away easy with that $3 over spot right now.
You bet.
So silver and commodity prices have been in lockstep going back, I should say had been in lockstep going back to the 2008 great financial crisis. That is until after the pandemic they began to diverge and commodities increased quite a bit while silver actually lagged pretty hard. So, Peter, what brings this relationship back into correlation? Is it commodities going back down or silver moving significantly higher, or is this relationship now permanently altered?
So, no, I don't think it's permanently altered. I do think that there is some risk, especially with recession, economic, especially if you get something globally, some kind of an economic slowdown, to see some of the more base metals, perhaps energy, some of the energy sort of dialed back a little bit. But given what despite that, some of the numbers are still showing pretty strong economic strength in the U.S. in particular.
Mm-hmm.
Um, there is certainly the potential for a scenario where you don't get that kind of a slowdown. I think silver will more than likely, we're going to see silver catch up to adjust for that. And if you look at the reaction over that time. I mean, silver has a fair ways to go to catch up to the average commodity. If you look at, I think really one of the important things is that at least for the next few years, what we're going to see, there's the dynamic is demand supply. I think the first leg of this, what I believe is going to be a strong sort of decade-long, at least, commodity bull, is going to be driven by lack of supply, potentially, rather than sort of outsized demand. So I'm not saying demand won't grow, but I think that it's going to be lack of supply that's really going to drive price. And then we're going to probably have this shift perhaps halfway through the bull cycle. And it's going to be perhaps after an economic recovery, and then you're going to start to see demand is going to start to really kick in and supply will not be able to keep up. And so the push will come from the demand side, more so than lack of supply.
So you talk about the supply side. Are industrial users rating silver ETFs right now? Like looking back through the charts, SLV never saw sustained falling inventories, not even during major price corrections. But since 2021, it's actually down 40%. So what's happening here? What is the impact of the falling inventories going to
So
be?
if you'd like, I've got a chart I can share with you.
I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and of course, all of the interviews that we conduct. And when you subscribe, we want to give you a free gift. It's a report that we wrote based on an important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe. It's free, and get the free gift. Also,